Hello, this is Jay Capel, author of Seasonal Stock Market Trends. In this brief piece, I would like to talk about the power of seasonal trends in the stock market. As a commodity trading advisor for 9 years, an independent investor, and as a writer and researcher, I have found a great deal of value in seasonal analysis, and I'd like to share some of it with you now. I presently write a column entitled Capel's Corner at optionetics.com. And I have also written several books on trading. As I mentioned most recently, Seasonal Stock Market Trends came out, published by Wiley in 2009, and was recently listed as one of the top 10 trading books for 2009 in the 2010 Stock Traders Almanac. In the back section of the book, the things I wrote about was something I call the Known Trends Index, or KTI for short. This is a compilation of 13 different seasonal trends. And the relevant question that we want to ask at any given point in time is how many of these trends are bullish right now. Historically, the KTI has ranged from -1 to +8. Before we can make any sense of this, people always ask, well, what is a seasonal trend? So let me give you two examples. One a bullish example and the other not so bullish. First one is called holiday days. If you were to hold the Dow Jones Industrial Average Index, the 3 trading days before and the 3 trading days after each major market holiday since 1933, had you started with $1,000 at that time, your equity curve since then would resemble that which appears on your screen right now. Clearly not a straight line advance, but definitely an upsloping, uptrending seasonal factor. So now the other one is month of September. Most people know October is the month of the crash. However, in reality, September is actually the worst performing month for the stock market historically. Had you started with $1,000 in 1933 and invested in the Dow, only during the month of September every year, your equity curve would look something like what you see on the screen now. Basically, you would have lost about 40% of your capital over the last 76 years. So this is an example of a negative seasonal trend. So why does this matter? Well, what we're going to do is we're going to consider the performance of the Dow Jones Industrial Average at various readings from the KTI. On the table that you see on your screen in the upper left, KTI reading, and what you'll notice is that the low readings, -1, 0, 1, have all been accompanied by negative returns for the Dow. So basically, even though since 1933 the Dow has gone from a level of 100 up to 10,000, you would actually have lost money if you had only been in the market when the majority of seasonal factors that I list in my book are unfavorable. Now, if you look at the bottom line on this table, you'll see that if the KTI is reading 5 or more, meaning at least 5 of the seasonal trends that I write about in the book are favorable, the Dow advances at a rate of 37% on an annualized basis. On your screen, you see a chart. If you had started with $1,000 in 1933 and only invested in the Dow, when the KTI was +5 or more, your equity curve would resemble what's on the screen right now. Clearly, this type of gently upsloping equity curve is what most investors are looking for. To round out the picture, though, had you done the opposite, had you only been in the Dow, those times when the KTI was +1 or less, that $1,000 starting in 1933 today would be worth about $38. To put it another way, you would have lost roughly 96% of your starting equity. And finally, if you put it all together, if you went long the Dow only when the KTI was +5 or more, and you went short the Dow if the KTI was +1 or less, the equity curve appears on the screen now. Basically, each $1,000 starting in 1933 would be worth roughly $1.4 million as of today. So this gives you some idea of the power of seasonal trends in the stock market. I'm Jay Capel. Thank you very much.